Hi everybody, and welcome to our webinar called Container Logistics in 2023. Let's predict and prepare. Awesome to have you all dialed in. My name is Christian. I'm co-founder and CEO of Container xChange, and I have here with me an awesome group of panelists joining us today to discuss 2023 trends and predictions and how to adjust your strategy. With Eric Johnson, Director S&P Global and Senior Technology Editor at one of our most favorite publications to read in the morning, JOC.com. We have Benny Huygen from KUEHNE Nagel, Belgium, who's a Commodities Business Development Manager. And we have Supal Shah, who's CEO at ARCON Containers. Very illustrious round. Thank you all for taking the time. We were already talking about this before we went live. I think the year end is a very, very busy time for everybody, but particularly, of course, everybody in container logistics to wrap up the year and prepare for the next. And so a massive appreciation for you guys to join us today. We also, of course, welcome everybody who is still joining us. So I see the people counter, the attendee counter still ticking up. We're waiting a couple of more minutes to give everybody a chance to really be online. And while we wait, please feel free to use the chat on the right-hand side of your screen to say hi, introduce yourself, which company you're from, and maybe also what you're looking forward to as part of this webinar. I'd like to mention that today's session will be recorded, and the recording will be shared with everybody after the event, together also with the slides that are part of this and the notes that we're going to be taking. You'll see that we're using a virtual whiteboard to take some notes of what we're discussing, and then we share those after the event. Lastly, before we jump into it, there's also a poll section on the right-hand side. So probably below your chat window, there's a polls sort of button, and if you click on it and answer a couple of questions, I think that would be awesome for us to also understand a little bit better our audience, who's joining, and what you're interested in, and how you view 2023. So trying to make it a little bit interactive here. Perfect. I think I still see some people joining, but I think I've talked long enough, sort of as introduction. So let's maybe get started. And maybe let's start with why we are doing this webinar. Why 2023? Let's predict and prepare. The reason, of course, is that we've seen huge number of disruptions in the past 3 years, and it has become increasingly important to predict and prepare for the year ahead. It has always been important to have a plan, but I think this has been increasingly the case over the past 3 years. And now looking at 2023, the year is looking already a little bit scary for some, exciting for the others. Some common fears are, of course, a total shift in demand and supply, what's going to happen to vessel capacity, what's going to happen to container capacity, what's going to happen to consumer demand. I think all of these macroeconomic almost factors and trends play a role. Then soaring taxes, pending recession, high fuel prices, more worker strikes. So all of these topics play a role and need to be considered. But of course, it's not all doom and gloom. In every crisis, there lies an opportunity. And if we prepare right and set the right sort of things in place, then I'm sure that most of us can actually have a very profitable and exciting year ahead. Before we sort of jump at 2023, let's maybe look at our current year, 2022, and reflect on this a little bit. And maybe to stop talking also and let our panelists sort of weigh in and have a word. Maybe starting with you, Eric. It would be awesome if you could guide us through what you think were the major events that sort of impacted the industry in 2022 from your point of view.
Yeah, Christian, thanks so much. Glad to be here. And yeah, it seems weird to be already recapping 2022, but we are less than or about 3 weeks out from turning the calendar. So I think most of the things that I'm going to mention are hopefully things that you all are highly aware of, because there were 2022. It didn't seem like we could have a more crazy year in our industry than 21, but somehow I think we did surpass that in 22. Obviously, first mention has to be the war in Ukraine, the invasion, however you want to describe it. It's had a massive impact, particularly in Europe, but really on rippling out into global supply chains. So clearly that was early in the year. That was end of February. Clearly has tinged the entire market throughout the year. The other kind of bigger element, I think that's had a big impact on supply chains is sort of China grappling with COVID in its sort of the final stages of it being a pandemic that had really hamstrung the world in terms of movement. Literally this morning or yesterday, China has decided to roll back some of those restrictions, but it's really impacted the ability for particularly factories to operate as normal, and suppliers obviously to be producing goods for buyers in North America and Europe in particular. The other few things that I'll mention, in the US, we've seen a lot of, I won't call it disruption, but sort of displacement of cargo due to ongoing labor negotiations with the West Coast dock workers. That's seen a big amount of volume shift from West Coast ports to East Coast ports. You mentioned strike actions. Those have been happening throughout Europe as well, and that continues to be less of a sort of coastal or region-wide phenomenon as it is in the US, but it's at specific ports or in specific countries, it's having a huge impact. I think the lopsided nature of 22 is also something that's really interesting, and I think will present some very ahistorical comparisons in 23 and 24 when we sort of look back to compare growth and volumes and equipment availability metrics from 23 to 22, because everything was front loaded in 22, partly because of the labor issues in the US, partly because people were so wary at the beginning of 22 about not having a repeat of 21 with lack of access to capacity and long transit times for their goods. So they added more time to their supply chains. So that had the impact of sort of flipping the holiday season a lot earlier, both major trades. And then the last thing, and you referenced this too, is just what we don't know what the impact of inflation is yet. And it's varying in different markets. It's gone up massively in both Europe and the US relative to historic norms. US consumer spending is still strong, but is that just through the holiday and then it sort of tails off at the beginning of the year? Or do we get a whole bunch of discounts and then starts to sort of resemble a normal pattern of buying and replenishment next year? Europe seems to be a little bit more in the red zone, primarily because energy costs are taking up a huge percentage of people's disposable income. So it seems hard to believe that 23 could be more crazy than 22 or more things, but it feels like we say that at the end of every year now. So I do not own a crystal ball on that, on whether we will surpass the craziness of 22. But I think everyone's kind of hoping for a little more stability wherever it may land.
Yeah, I think that everybody can echo that, and unfortunately, none of us have a crystal ball. But I guess 23 will certainly also have its surprises. Let's see whether they will be as major as in 2022. Yep. Okay, and maybe sort of going into sort of the actual the operational business and looking at you, Supal. And I know that in of course, due to COVID and the almost like the extensions of container turnaround times and the resulting scarcity of containers, there was a significant impact on NVOCC operators, container traders, etc. So how has this container deficit impacted your business, and how is now this sudden shift or the flip sort of impacting your business to container oversupply?
Thank you, Christian. So let me add my point that there were enough containers available, right? Even probably during the COVID or post-COVID. So there was never a shortage of container. There were operational bottlenecks, lockdowns in different parts of the world, the lack of labor to manage the complete global supply chain. So there was various reasons where the equipments were not available at the right time in the right place. So I think that was the biggest challenge. So last 2021 was an excellent market, because whenever, especially post-COVID, I think the entire or all the stakeholders within shipping and logistics has gained from post-pandemic challenges. So as far as container business, whether it is an NVOCC or container trading or leasing, we have experienced huge demand. And in fact, the last 24 months up to June 2022, the market definitely was quite expensive. And one of the reasons that there was, on one side, there was operational bottlenecks, but on the other side, most of the government was pumping the liquidity. There was a binge buying, huge consumptions of electronic items, food items, medical equipments, so which probably was requiring huge demand for container, apart from definitely operational slowdown. So there was, and most not to forget, multinational freight forwarders were chartering vessels. So again, huge demand for SOC containers, or we call, say, one-way container. So all these led, definitely, we all know the prices of dry vans went from probably $2,000 to almost touching about $4,000 before it reversed from probably July to August 2022. But your questions, what is a sudden container oversupply? Yes, that's the fact. So let's understand, the Chinese manufacturer were producing a hell lot of containers since last 24 months. And shipping lines were not returning old container. Normally every year, after 15 years, most of the shipping lines will off-hire old units to leasing company, which did not happen in 2020, 2021, and up to half of first 6 months of 2022. But now the scenario is different. It is difficult for second-hand container now. And I strongly believe for next 12 to 18 months, the situation will remain the same, at least for second-hand container. Not to forget, China is still struggling to manage COVID. While it is very positive news, now they are opening up their market. They are reducing the COVID restriction. And I hope that the Chinese factories will be able to start working, like a pre-pandemic level, because it is still a China which is export hub for the world. And another factor to add, most of the big Chinese manufacturer, earlier they were working with 3 shifts. Now they are only working with 1 shift. So they are also reducing the supply of the container. But I strongly believe for next 12 to 18 months, those, probably in audience who are into the container leasing or container trading, it's going to be a tough market, because, as Eric said, we don't know how the inflations, because probably most of the Western countries are consuming the less cargo. So there are less orders with Chinese factories, and this will definitely have an impact, overall impact on the demand for container. It's going to be interesting to see CMA, Evergreen, MSC, they all are expecting to take the delivery of the new vessels. So how the overall shuffling between the, getting rid of old vessels, taking the new vessels, because again, most of these vessels will start from Far East. So again, there will be huge demand from Far East for container, but it is too early to judge the overall impact, on the demand and supply because of the new supply of vessels. So that's my take on this.
Gotcha. And what does this mean for your business?
Yeah, interesting. Because I think Christian, xChange and ARCON more or less we are very closely working together, right? So earlier, as a ARCON as a one-way service provider, right? Definitely the one-way pickup fees has gone down. The trading market, the overall demand for second-hand containers, we do not see a big demand coming. So overall demand we are missing right now. So we need to be careful. We need to identify the niche market. There are niche market in the world, whether you say Africa, whether you say Latin American countries. Like India itself is demanding huge container, right, for domestic market. So I think for next 12 to 18 months, now the real character of the companies will be tested. And most of the entrepreneur or the salesmen, they need to figure it out, their niche market, and making sure that they keep the quality of the services top notch, and because I strongly believe it's going to be 12 to 18 months journey, because container, there was always a cycle where I strongly believe the demand will come back, but next 12 to 18 months look difficult. So find your own niche, remain lean with your expenses and resources, and maximize use of your resources.
Yeah. Makes sense. Makes sense. And if I so now we sort of looked at container and the container market, etc. And if I look at you, Benny, what do you see on the freight rate development? So what was the trend in 2022 that you've seen that has impacted your business? And what were some underlying drivers of that?
Yeah, thank you, Christian. What we saw in 2022 was that the rates went down drastically again, some more drastically than others, but several lanes are again at pre-COVID rates levels. It went down like it was during certain periods. It was like almost 10 times more that the rates that the levels were. Now it's again at the pre-COVID levels. The main reason for this is like Eric said, the Ukraine situation and resulting in a more or less worldwide crisis or recession, mainly in Europe. People are distrustful. They don't know what to expect, what they have to pay for their energy. They consume less. They are importing less from Asia. In Asia, because of that, they need less raw materials. So also export is went down in 2022. So yeah, it's causing a real imbalance between the capacity on the vessels and the demand.
Yeah, makes sense. So you say it's actually sort of okay. It's an imbalance situation between supply and demand, which now really shows and reverses those prices.
Yeah.
Okay, and we've also sort of read and heard a lot about sort of depots now being especially challenged because you have a deficit, an imbalance between supply and demand, and there's a significant oversupply of containers now, which of course are sort of out of cargo, so to speak, and they have to be stored somewhere. What's your view on depot operations, depot congestions, especially in 2022? What have you seen so far?
They are slowly recovering. The terminals and depots are slowly recovering from the peak situation that we had like a year ago. This was mainly caused by the delays of the vessels. Exporters were used to deliver their cargo on the terminal, and the vessel would take them at the end of the week, as a way of speaking. But then the vessels started delaying everywhere, in the transshipment ports, in other ports, because of strikes, because of lack of workers, you name it. So the vessels were arriving sometimes weeks weeks later than foreseen. So the containers were already on the terminal waiting for the vessel, but they had to stay there because the vessel wasn't there yet. And it more and more containers were delivered on the terminal. And then finally the vessel arrived. A lot of containers were taken off the vessel, and then the importers waited too long, or longer than usual, to take their containers from the terminal. So this resulted in a real congestion on the terminals. Sometimes some ports in the Hamburg-Le Havre range were at 95% of their capacity at moments. That means only 5% room to maneuver the containers and to work with the containers. Currently, it improved a little bit. We estimate that it's somewhere in the 80% that the capacity of the terminals is now, but still it's quite high. The use of the terminals, they are still very full at 80% or 85%. So there is no room for flexibility. We still have to have these yard opening times for vessels. If the vessel delays, the yard opening also delays. So if you plan to load a container tomorrow, and today the vessel is delayed by 2 days, there's a big chance that you are not able to deliver the container at the terminal. So this also results in then the container has to be stocked at a trucker or in another depot. So that is a rolling effect. All the trucker space and all the depots where normally container they are usually not that full. They are also very full because of these situations. So yeah, it's improving a little bit, but not yet to a big extent.
Okay, and what's the sort of, when you say 80% is still relatively tight, of course not as much as 95%, but what's a sustainable level? Maybe also looking at historical rates.
I don't know the historical data, but I think it should be somewhere around the 70%, which is comfortable for the terminals to work.
Okay. Okay, cool, interesting. And when we look at, so now we talked about sort of containers, we talked about freight rates, we talked about depots. If we now talk about trade routes and trade lanes, Eric, what sort of trend or change did we see in existing or new trade routes, especially in 2022? Anything that is to highlight here?
Well, so a couple things I would mention. First of all, I think big picture, trade attempts to always take the path of least resistance. So I think we saw a lot of shifts. I had mentioned before that there was a lot of volume that normally goes from Asia to the US West Coast that started moving to East Coast ports because there were some operational bottlenecks. The same sorts of things that Benny had mentioned were happening in Europe, were happening in LA and Long Beach in particular, where the bottlenecks on the land side were backing into the terminal, and that was preventing ships from being worked. So you had obviously this huge backlog of ships that was well reported. So trade moved elsewhere, and the zero COVID thing is another example of, imports from China specifically into the US went down on historically, but the volume of imports into the US as a whole from all regions didn't go down at nearly the same rate, which means people were shifting, their sourcing to other markets. And, this isn't just a recent pandemic phenomenon. We've been talking about China +1 and China +2 strategies for 15 years or more, right? People have always wanted, contingency plans and diversification where possible and where it made economic sense. I mean, in the meantime, China became this export, powerhouse, not just in terms of making goods, but the logistics networks that sort of supported those movement of those goods to ports and the huge amount of port capacity that they had. So definitely 2022 will be an interesting year historically to look back at some of those patterns breaking a bit. The question is, how permanent are some of these breaks? Definitely, we've seen volume move to port sourcing regions in Southeast Asia, so Vietnam, Indonesia. We've seen South Asia, India, Bangladesh, especially on the apparel textile side, really consolidate their areas of strength, and people really talking about moving to production to India in a real sort of more systematic way than they had before. Again, though, I think there tends to be an overstatement of how much activity has already occurred versus what people are talking about. Yes, some volume and a significant amount of volume shifted to other regions. But when people talk about shifting trade patterns and reshoring, the data doesn't yet support that there's been this massive shift out of China permanently, right? It's opportunistic, it's here and there. And, I think one other element that I'll point out is that was unusual in 21 and 22 is we had a lot of vessel capacity sucked into particularly the Trans-Pacific when demand was going absolutely crazy in North America. Some of those ships returned back to their sort of north-south or niche and feeder trades, especially into developing markets like Africa. They've switched back. And so those trades should start to be served a little more regularly than they were potentially in late 21 and early 22. And I'll just note one other thing. Yesterday, or actually it was Tuesday, CMA CGM just announced that they've bought 2 terminals in the Port of New York. Why am I bringing this up? Well, in the course of talking to CMA about the motivation for that, I asked, are you seeing this permanent shift to the US East Coast in terms of both transatlantic trade, which has done really well this year, but also a shift from Asia to North America? Is more of that volume going to be permanently routing to the US East Coast? And they said it was less about that, and it's more about just building in flexibility and adaptability, right? And so if a major shipping line that's buying assets is thinking that way, shippers and all the service providers that cater to them are obviously thinking in that same way as well.
Also, Christian, I will add a few points to Eric. I was a part of another panel discussion, and one of the speakers brought to my notice that post during last year, the business between G7 countries has gone up. So import and export in terms of the percentage value, not volume. So definitely, I agree with Eric. Somewhere business between G7 countries has gone up. And my personal belief that before 2 years, the ocean freight rates was moderate. So the global China or the world was sourcing a lot of consumer cargo or the less value cargo from China. But in between, right, the last 18 months, the freight has gone up 10x. So I think it is yet to be seen, because now the freight rates are quite moderate. Now definitely we will see how the world is sourcing the cargo from China. Definitely China plus strategy is coming, but China has a scale. So I strongly believe now freights are moderate, and next 6 months probably we will be able to see whether there is a real shift in sourcing, or this was just a temporary, because of various pandemic and the war related issues. Yeah.
So, Bo, let me just add on one thing. I've actually thought about this a lot. There's been a phrase in shipping that low rates never induced more demand, right? Like, just because rates were $50 instead of $3,000 didn't mean shippers would ship more cargo. But as Subbo rightly mentioned, there was some freight over the pandemic that was priced out of the market. It just didn't make financial sense. The rates got so high. So I am wondering whether he's correct in terms of, is there some latent demand for low cost goods that now the rates are affordable and the total cost structure actually makes sense? So not to say it is inducing more demand, but it's unlocking latent demand that was prohibited essentially or constrained from being moved during the pandemic. So great point, Subbo.
Mm-hmm. sorry, I just need to take this down. Yeah. Okay. Okay, cool. Makes a lot of sense. And if we already, so this was actually sort of our segment about reflecting on 2022. If we now shift focus a little bit onto 2023, and we touched upon 2023 already a little bit. And on the screen, you will also see a few results from a recent survey that we've done on LinkedIn, actually. And we can also use and leverage these stats to reflect on as we discuss similar topics. If we now sort of, again, look at 2023 and stay with you, Eric, what are the main forecasts that you see, apart from what you've already mentioned in terms of, volume shifts, for example?
Well, as I said before, the crystal ball is a difficult business to be in these days. I think most people are landing on the idea that we're either in the start or we are soon to be in technical recession, depending on how you define it, and even that's come into question, right? And obviously, different regions are at different phases of this. And if we are in a recession or about to enter one, it will be longer in some regions than others. I think my colleagues at S&P who do forecasting on trade are predicting a pretty moderate 23, if not, somewhere in the neighborhood of a slight uptick in global volume over 22 to even potentially a small retrenchment, with then 24 volume kind of really being healthy. I think that the thing that I just mentioned before about whether there's a bunch of volume that's sort of that will be unlocked both by a lack of port congestion as well as lower rates, whether that sort of, kind of comes back into the market on the demand side. I'm especially interested to see how orders from importers to their suppliers in Asia sort of ramp up or don't ramp up in the first quarter, because there's a huge amount of momentum to sell through items during the holidays, even at deep discounts, basically giving stuff away to sort of secondary retailers. And so much of the import demand in the US is driven by consumer goods. If we see retailers burn through their inventory maybe faster than they had predicted in, say, September, we could start to see those replenishment cycles happen maybe faster than some people are predicting. There was a 3PL told me, who's in the apparel sort of import side of things, said he's expecting that replenishment will happen earlier in first quarter than most people predict, and he said it's not just a matter of demand, but it's also, and what I mentioned about COVID restrictions in China being eased sort of speaks to this, is it's also a matter of pressure from governments in regions where they are heavily reliant on tax revenue from their supplier base, their export supplier base. If they go one quarter with sort of subdued orders, that's manageable. When you start to get into a second quarter of subdued or absent orders, that starts to take a real toll on the local economy. So there's going to be a lot of pressure to subsidize ordering activity, and that those goods have to move somewhere, right? So it's really difficult to say what actually triggers it, aside from the U.S. consumer in particular staying healthy. I don't think we can expect the European consumers to buy the same way as the U.S. consumers will. But I think that for those first, not even quarter, those first 6 weeks pre Lunar New Year are going to tell a lot about how much replenishment retailers need to make to backfill a lot of the inventory that they're trying to burn through.
Okay, very, very interesting. And sort of now looking at the container market and container availability, of course, at xChange, we're always very, very interested how the dynamics of container surplus and deficit sort of play a role in impacting market trends, I would say. And if I look at you, Benny, what's your view on container surplus in 2023, and how will that impact, how that will impact sort of the market in general?
To be honest, we don't expect a global surplus of containers, rather an imbalance, especially in Europe. Currently, at this moment, 70% of the containers that are moving through the ports in Europe is import. Only 30% is export. So the ports will, the terminals will remain congested. There will be more containers coming in than going out for I expect quite a while. So the pressure will remain on the ports. Will this have the same influence on the freight rates? Will the rates continue to go down? I think we are more or less at the lowest rates possible. There is no use for the shipping lines to further reduce their rates. There is simply no export and also less import. So lowering the rates will not cause a huge booking wave with the shipping lines. So like Eric said, it all we have to see whether companies who were used to buy their products or produce their products in Asia. I read quite some articles about that for example, in Belgium, several Belgian companies who used to buy in Asia, they are now producing again in Belgium locally or in Europe. And to be honest, it makes sense if they have to cope every time with these huge peaks and in freight rates. Freight rates going down, multiplying with 10 times and then going down again. It's very difficult for those companies to make their calculations and predictions for their products. We expect that on the vessel capacity there will be an overcapacity the next in 2023. Clearly, we expect it to be about 30%. That doesn't really have to mean that the rates will go down, like I said. There are several factors which will have an impact on this overcapacity. First of all, the IMO 2023. So it's mandatory reduction of the carbon emissions of the vessels, and the main way to achieve those reductions is by steaming slower. So that means for a typical Far East, Europe Far East loop, it will mean that to guarantee the weekly calls in Asia and in Europe, there will be at least one, probably two vessels extra needed to guarantee that. So that's already some capacity which will disappear automatically because of the slow steaming. Another factor which will have an impact is that the lines will now start to scrap and dry dock certain vessels. During the past 2 years, every vessel, every TU on capacity was needed on the vessels, and all vessels were kept in service. Now it's time to scrap certain vessels which are already maybe 2-3 years overdue now, and also some maintenance. Some vessels will need maintenance and repairings, and that will also be done now. And this will also have an impact on the overcapacity. Thirdly, the shipping lines can also influence this. I read an article yesterday that since August till today, the shipping lines took out 7% of the capacity. 7%. This will not compensate the overcapacity, but it has an impact, and the shipping lines can take out more capacity. I think it's all in the hands of the shipping lines. If they want their rates to go up again, they will have to take out capacity for a while. It will also cost money. Not sailing also means outlays, but it's less than operating half-empty vessels, and because that's definitely costing more than not operating certain vessels or certain services and loops. So it's all in the hands of the shipping lines.
Yeah, but it's interesting. So you're not expecting sort of a further drop in freight rates in 2023.
Maybe another $25, or I'm now talking about export, $25, $50 maybe. For import, maybe another few $100. But like I said, it will not cause a massive booking wave. There is no need for the shipping lines to lower their rates any further, because it will not create more bookings for them. Maybe for a week or for a short while they will get some more bookings, but that's it. And the other lines will follow the rate that one of the shipping lines would put on the market. The other lines will follow, and then the advantage is again gone, and then you can start all at new. There is no need for that. The volume is simply not there.
Yeah, interesting. Yeah, in our poll, it was also the picture was very, very split, where 45% of respondents said that they expect freight rates actually to increase again, while 38% they said that they will continue to drop. I think our view is also more of a more pessimistic view, I guess, because it's in the end it's an oligopoly where it's pure game theory sort of at play. And shipping lines, maybe not, don't lower rates to unlock so much latent demand, but really to snatch away volume from each other, which I guess is something that we've seen in the past as well.
Christian, one other thing I would mention is the operating costs have gone up since the pandemic. So we're not talking about the same rate in 2019 doesn't cover as much of the line's operating costs as it would in 2022, 23. So there should at least be somewhat of a motivation to keep a floor on rates that's a little higher than it was 3 years ago. So,
and to add, not only operational, but even capital cost has gone up.
For sure.
Yeah, true. Yes. That's true. That's true. Okay, so what you're saying is then you expect the floor of sort of container rates to be variable costs of shipping, and because variable costs have increased, you expect the floor to be higher, so to speak.
Expect is a strong word. I don't know. you
would think looking into your glass balls.
Sometimes the market performs irrationally. So
yes.
And Christian, take a very small part of the business, right? For shipping line, storing empty container globally in depot, it's a very small operational cost. But if you see the rise in a depot cost globally, percentage-wise, the rates has gone up almost 60-70% in Europe and many other parts, including China. And there is no depot space, right? So in all, if you will add small parts, yes, there will be huge increase in operational cost.
Yeah. And I think actually this is a great segue to my next question, which I wanted to focus on depots. And Supal, what is your expectation on depot space, depot availability, depot congestion in 2023?
bad, extremely tough, because I'm expecting around 6 to 8 million TUs idling globally in next 8 to 10 months. And we'll see probably how the war, because war is definitely impacting the inflation. There is a shortage of fertilizer, there is a shortage of food and grain, there is a shortage. The oil is still very high. So I think at least 2023 looks bad. Giving an example, in India, we had a depot space. Easily, all the depots were idle before 45 days. And just within 15 days, the big shipping lines brought 10,000 TEUs, 15,000 TEUs. And right now, all the depot are already more than 100% of their capacity. So I strongly believe in 2023, the situations will remain the same most of part of the world. And if you'll go to China, even probably right now, to get the storage for 50 TUs, my team really need to fight with the depot. And trust me, we have a decent business relations with most of this depot. So especially for a mid-size, small to mid-size container leasing companies or a trader, container depot is going to be painful, both in terms of operations and also the cost. Idling cost of container in Europe has gone up to 2 to 2.5 euro a day per TU. So if you have a fleet of 1,000 TUs, then you end up paying around 2-3,000 euro a day just in storing your empty container, right? So looks bad, and let's see how these things will unfold. But at least for 2023, idling of the container need to be planned wisely, to manage the cost.
Makes sense, and it's also something that we expect. What do you like? What does that mean, sort of, for the second-hand container sale market? We touched upon this really briefly when we were talking about 2022, but summing all this up, right? Overcapacity, lack of demand, freight rates, TBD, depot space severely tight. What do you expect there on the container price side?
So Christian, container second-hand prices, it's a dominoes effect. Let's go back to post-pandemic, how the suddenly the prices has gone up, right? It's exactly the reverse, because today the shipping lines are off hiring old boxes to leasing company, and for a leasing company, even the existing price for second-hand container is still better compared to the book value, the depreciated book value. So they rather like to get rid of second-hand container rather than keeping the same and looking for the new customer who can take depot stock. So I think the second-hand container price, I strongly believe, will correct by $100-200. I think the bottom is very near, and one of the definitely reason, because there is always a market for container. It probably for 2-3 months we struggle, but there is always a market. But I personally don't see a very, very big corrections, because cost of capital also matter, because the cost of capital has gone up. During the COVID time, there were a lot of new players, and better than me, because xChange has experienced many new members, right? Because there were a lot of new players who started buying container, shipping it one way and selling containers. But with the change market scenario, I think many of those new players will find it difficult to continue in the way they were doing in last 18 to 24 months. So yeah, overall, I think we are near to the bottom of container price. Depot looks bad, but second-hand container market, there will be pressure on the price, but I don't see the price will be corrected, more than $100-200. So we are very near to the bottom of second-hand container price.
Very good. I think there's a lot of people attending the webinar who love to hear this and hope for the same. Let's see. Hope for the best. Prepare for.
And today you see, right? Because storing empty container in Europe is a nightmare. It's expensive. And if you will follow the xChange data, the pickup fees, which earlier the customers were paying to evacuate empty container from Europe, has gone down, right? So and today, honestly, I'm struggling to get container out of Hamburg, especially for few of the markets. So I think there will be impact. And I think the world is adjusting. We are in a transitions from post-pandemic. There was a sudden disruption. I think we will still take another 6 to 8 months to bring the, probably the stable market here.
Yeah. Yeah, no, and you mentioned it. Sort of, you follow the exchange data. It's also what we see, sort of increasing demand of our customers, of our members for data, both on the trading side as well as also on the leasing side. And they're sort of we've just recently launched our Insights product, which sort of gives customers, gives companies visibility on container prices, pickup charges, per diem rates, free days on specific routes. So really a lot of useful data to make better decisions. And also there, you're right. We see a significant drop. Now it seems that it's tapering off a little bit, but let's see what January brings. Okay, very good. We have only 10 minutes left in this webinar. I'd love to end on time just once. So I'm going to cut some of my questions a little bit short and leave it over sort of to the audience. I want to move to the Q&A. And I know there has already been a few questions sort of being posted here. So let me just move. Okay, so the first question, how to give lease my container overseas. As a young entrepreneur, I'm willing to do business overseas. So maybe doing a little bit of startup help here. I don't know, Supal, if you wanna take this. Anything you can suggest? I know that you just said that new entrants to the market will have a difficult time in 2023. So let's see. Yeah?
So if you are a new entrant, then better you give your container lease to the expert like ARCON or xChange, right? So no, jokes apart, my friend, I think for you as a new player, because container leasing is more like a banking and asset management business, right? Especially for overseas, credit risk management is a huge task. So maybe for you, maybe you can talk to xChange, and for you is to identify customer on xChange, request xChange to allow you to lease the container for a long term. Could be a good, better strategy wherein you can still manage your credit risk, and increase your business.
Yeah. Cool. I hope we have answered that. And yeah, please feel free to get in touch with any of our sort of experts. Also at xChange, happy to provide some clarity on what there is available in terms of resources and what might not be. Next question: what is the future of foldable containers? Any view here?
I can take this question, Christian. So interesting, friends. I have spent quite a lot of hours in studying the foldable containers. Excellent product, especially for a shipping logistics, where 12% of the global operational cost is just repositioning empty container, and foldable container probably was looking an excellent solution. But the problem with foldable container is the limitation in terms of the carrying capacity and the actually operations, because even if looks easy on the YouTube video, but actually when you operate one foldable container in container depot, that takes away probably around 4x or 5x time than handling one normal container. So unfortunately, so far operationally, this foldable container is not looking that simple. And compared to the normal drive-in, and understand that globally shipping is all about the scale. So at least for a time being, this product is not accepted by shipping lines or NVOCC. So time being, honestly, I'm not very, very positive for foldable containers.
What do you think has to change to change this?
Sorry, Christian?
What do you think has to change in the market or with foldable containers in order to almost like give them a future? Anything that you can say there?
Yeah, so the whole idea for a foldable container is to save on the repositioning cost. You can bundle, one container on top of another. That was the whole idea, right? But we need to find a new design when operationally we can fold the container, on few click, or maybe using an IoT devices to make sure that instead of people, because labor globally is expensive, but if we can find out the technology, or xChange wanted to invest in a research in a technology wherein sitting on a central room in a depot, you can control the folding of the container. Maybe that could be a possible solutions to increase the demand for such containers.
Gotcha. Okay. The improved technology can help that. Okay. Next question. Carriers are still buying more ships. Will they continue buying containers from China? Views here.
At least for a time being, what I learned, most of the carriers have put a hold on buying containers from China, right? So at least time being, liners are going very slow because they have enough container. The depots are full of containers. So I don't see liners will buy container for next 8 to 12 months in a very, very big quantity.
Mm-hmm. Yeah, makes sense. And maybe let's take one more and then to wrap up on time. In terms of SOCs, will major lines start accepting SOC on major routes? I think this always depends also on your personal negotiation power vis-a-vis lines, etc. But what's the view here from the group? Because I know that pre-pandemic also SOCs were quite accepted also on major trade lanes from China, for example, into Europe and Trans-Pacific, just because they allowed liners to do the business without having to provide their own boxes. Any views here on the trend for SOCs?
Maybe Benny, you can take this question.
Well, yeah, it all depends on the lane. Specifically from Europe to Asia, it has always been difficult to get a line accepting SOCs. But I know that there for other lanes, for example, from the US, it's I heard it's a bit easier to find a shipping line giving coverage for or acceptance for SOCs from Asia nowadays. It will not be that difficult. I assume to find a shipping line accepting SOCs, and from Europe, it's a bit more to find the shipping line accepting SOCs. It all depends where the shipping line needs their containers. If they need, like in the previous 2 years, if they have a huge need for their own empty containers in Asia, they will not accept any SOCs. If it is like now, then when they don't really need their empty containers, when they have their own overstock in Asia, they are more willing to accept SOCs. It all depends on the lane and like Christian said, your capabilities of negotiating this acceptance with your contact at the shipping line.
Yeah, makes sense.
Maybe shipping lines will ask for some extra dollars, to load your SOC containers, but there is always a solution.
Yeah. Makes sense. Good. We're nearing the end of the webinar. What we'll make sure to sort of to the audience, we don't want to leave any question unanswered. So we'll pause here though, and we'll make sure to get answers to the remaining questions after the webinar, so that we're able to distribute those as part of our attendee package, so to speak. So all your questions will be answered. So make sure to still put them into the chat or into the Q&A section. At this point, it's on me to say once again, thank you very much. This was a lot of fun, very, very insightful. Thanks a lot for the good discussion with very interesting viewpoints. One more time, if you're interested about sort of gaining more visibility on data on container prices, on leasing charges, leasing trends, etc. We are doing a LinkedIn Live, I think next week actually, yes, on the 13th of December, about our Insights product, really showing you how to leverage that product, how to make use of the data available for your own decision making. Would love to see you all there. Of course, sometimes we also have to do a little bit marketing, so just want to position this here. Thanks again. Was a great pleasure. I let you go, get back to your 2023 planning, all of you, and hope to see you all again very, very soon.
Thank you, Christian. Thank you, Eric, Benny. Thank you very much.
Thank you. Bye.
Thanks all.
Bye-bye.